Cisco, the networking giant, just reported its first quarter since the retirement of longtime CEO John Chambers and his replacement by Chuck Robbins. I've been a fan of Cisco. Company's been moving into new high-growth areas like the Internet of Things and cybersecurity, not to mention getting out of lower-margin businesses like the set-top box division, which in a terrific move that boosts overall margins, the company sold for roughly $600 million near the end of July. After looking over Cisco's results today, it seems to me that the strategy is working from the get-go, and Chuck Robbins is clearly able to execute, delivering a strong quarter right out of the gate. Company reported a 3-cent earnings beat off of a 56-cent basis, higher than expected revenues, robust guidance for the next quarter has to be one of the best information technology quarters I've seen this year. So let's check in with Chuck Robbins. He's the new CEO of Cisco. Hear more about the quarter and what's next now that he's taken the helm. Mr. Robbins, welcome to Mad Money.
Hey, Jim, as John would always tell you, you have to call me Chuck. So it's great to be here. Thank you.
And I will call you Chuck. Chuck, I saw some things in this release that are very different. One of the things right out of the gate, you actually gave the guidance in the release, which made it very clear that you're bullish about the future of Cisco.
Well, Jim, I am bullish. And first of all, we're really pleased with the quarter that we just had. We obviously had record revenues. We had record non-GAAP EPS. We grew our orders by 4%. And at the same time, we grew our deferred product revenue by 21%, which is reflective of the transition that we're driving in our business. So overall, we're incredibly pleased. As for the format change today, we listened to our shareholders. That's what they asked us to do. They wanted more information in the press release up front and more time for Q&A, so that's what we gave them.
Well, I want to go back to the deferred revenue growth. 20% growth in deferred revenue marks really, to me, the transformation from a hardware to hardware and software company, because what we get when software companies come on Mad Money is they talk about deferred revenue. The importance of deferred revenue is it gives you a sustainable look at the future, and that's new for Cisco in terms of the way it reports.
It is, Jim, and if you think about where we had tremendous success, take collaboration, for example. A couple of years ago, we said we're going to transition that portfolio, we're going to refresh the product line, but we were also going to move to a cloud consumption and subscription-based model. And this quarter, the team grew collaboration 14% and also grew our deferred revenues over 20%. So we accomplished both. We also had tremendous growth in our security deferred revenue, our subscription and software business there. So we're very pleased with where we're headed there, and that is indicative of where we need to take the company.
No sacred cows. You got out of a business that I have asked John Chambers about many times, and it's always been the big downer in my interview, set-top box. No room for companies, for divisions that aren't cutting it?
Well, as we look at what our customers are going to need from us as they make the move to digital IoE, we're looking at what is important in our portfolio. And this whole issue around the set-top box, we began that discussion 120 days ago. John was actually obviously involved, and I was involved with him. Right. But what we really want to do is make sure that the elements of our portfolio really align with where our customers want us to go, where our partners need us to go, where our shareholders would like to see us. And so we'll continue to evolve our portfolio in any way we need to, whether adding things to it or whatever we need to do to align with what our customers expect from us in the future.
You talked directly about being acquisitive in the area that we think is the fastest growing area of any business on earth, cybersecurity. You're going to make acquisitions. Well,
Jim, when you think about it, security, as we think about this hyper-distributed infrastructure that's going to be required as we connect everything, every customer, every company is going to connect everything, whether it's connecting mining facilities so that you can know ahead of time before a truck's going to fail, or connecting retail so you can predict the behavior of a consumer. Everything's going to be connected in a very distributed way. And that requires a network, which is what we do. It also is going to require the network to actually become a sensor as it relates to security. So we think that security is a tremendous play for us, and we'll use all of our levers for innovation to actually build out that architecture. We'll innovate and drive our own internal R&D. We'll acquire where necessary. We'll partner. We'll look at strategic investments, and we'll do co-innovation and co-development with customers where it makes sense as well.
Chuck, can you speak globally? We know that China, all the headlines read badly. You've got a business in China, but John's been saying, listen, it is political when we'll turn. Europe in transition. Brazil, obviously not good. We all know that. Russia, not good. But Europe and China didn't seem to be that bad for Cisco.
Well, if we start with China, I think it's important to understand, Jim, China is only 3% of our business. So our exposure there right now is very limited. However, we all know it's the second largest economy in the world. It will become the largest economy in the world. And so we've been there 20 years. We're committed to China for the long term. We have spent a lot of time over there recently, and we really understand what's going on. But right now we have limited exposure, but we're very committed long term. When you look at Europe, overall, without Russia, EMEA for us actually grew 1%. So I think our teams in Europe have performed much better than our peers have over the last 4 or 5 quarters. And I think relative to what's available in the market share there, that we'll continue to perform well. As it relates to emerging markets, the story is very similar to what it was last quarter. It was -2, but if you take out BRIC plus Mexico, it actually was positive. And we think as they turn and the macro and geopolitical issues calm down, we'll be the beneficiary of a return to growth there.
One thing you're keeping in John's playbook, you're turning a lot of capital in ways that are clear. You bought a lot of stock at 28, which right now, given the fact your market cap just passed IBM, by the way, at 29 and change, looks like a pretty good buy for the company. You were in there buying pretty much the whole quarter, huh?
Well, you know, I'll leave that with Kelly and our treasurer relative to how we're driving our share buybacks. But we're very committed to the shareholder return. We're committed to greater than 50% of our free cash flow, and we'll remain committed to that in the future, Jim.
All right, I want to go over this accelerating what's working and changing what's not. That says to me that there are still parts of your portfolio that you are not happy with, and that going forward, we should not be surprised if we see some further shufflings of things that you're not pleased with that necessarily your predecessor might have said was okay.
Well, Jim, if you look at what I'm talking about, when I talk about accelerating those things that are working, I talk about our operational capabilities, I talk about clarity and simplicity and our culture and talent. The real thing about it is that there are times when we can just execute more effectively on something that is already working. And so I think there are a lot of areas of our business that we will continue to accelerate. I talked about Meraki. I talked about collaboration. We talked about security on the call. We talked about how we're doing in the data center and the switching portfolio, our high-end routing and service provider. So those areas we will continue to accelerate as we can. And again, we'll just evolve our portfolio in light of what our customers want to see from us in the future.
Last thing, Internet of Things. What inning? John used to give us some perspective of where we are now versus where we'll be 4 or 5 years from now.
Jim, it's very early, but every country, every company, we've talked about it, is looking at how digitization fundamentally changes their business. For years, IT's been a cost center. Now companies are looking at how technology can fundamentally redefine their strategy as a company or redefine how they think about job creation or inclusion or anything that is a priority for any country around the world. So it's early, but the things that are made possible when you build out this distributed infrastructure and you expose the value of the data to the customer, which is the most important asset they have, we believe that it can fundamentally change a business, fundamentally change a country, and we're at the center of that with a network, and we're really excited about the opportunity.
You very much are. Chuck Robbins, congratulations on your first quarter, which was definitely an upside surprise. Good to see you, sir. Thank you.
Thank you, Jim. Have a great day.
You too. That's Chuck Robbins, CEO of Cisco Systems, which looks to be breaking out at the close. This was the strongest of the big information technology quarters that I've seen so far in 2015. Mad Money's back in.